Hi, fine evening. Hope you
How
are
are
good.
you? I'm fine, and you?
My God's grace. Welcome back.
Thank you, boss. Eh, okay, so last time we ended with the borrowing costs, and the video is on the channel, so please kindly watch it if you were absent from last Thursday's class. Okay, so today our
Why
focus
can
will be
explain this message is directed to me?
oh no.
Okay. Mhm.
I think by now you've watched it, or
I'm halfway through. I'll finish tonight.
okay. And please, the revision, don't forget with it. So don't be piling up. You see, the standards are plenty. Okay. So today our focus will be IS 36 and IS 38. That is impairment and also intangible assets. Impairment. Now you've been hearing impairment every time with the asset standards. Sometimes you are saying that the carrying amount, okay, of an asset is the cost of that asset minus accumulated depreciation and also any impairment losses. Now, one thing you should know that is that we have impairment loss, but we don't have impairment gain. We have impairment loss, but we don't have impairment gain. Okay, so we are saying that this is the objective and scope of the standard. Uh, so that one you can read it. Now, what do you mean by impairment? You are saying that an asset is said to be impaired when its recoverable amount is less than its carrying amount in the statement of financial position. Okay, so when a carrying amount of an asset is greater than the recoverable amount of an asset, then you know that there is an impairment. There is no impairment, as I said, when the recoverable amount is more than the carrying amount. So this one we have here is the impairment loss. Okay, this one is the impairment loss when the carrying amount. So if the carrying amount of an asset is 6,000, the recoverable amount of an asset is say 4,000, then carrying amount is greater than recoverable amount by what 2,000. So this 2,000 here is what we call impairment loss. Okay, but where your carrying amount is, let's say, 5,000, this is your carrying amount. Recoverable amount is, let's say, 10,000. Then we say that there is no impairment. Don't write 5,000 and say that, oh, this one is impairment gain. No, we don't have impairment gain. All right, so that's all you should know. And we are seeing our recoverable amount. And what do we mean by that? A recoverable amount. Now, uh, so basically, the impairment is carrying amount minus recoverable amount. Okay, that will be your answer. Okay, so I want to use the diagram again. So let me start with impairment. All right. So the carrying amount, we know carrying amount already. We've been doing asset standards since we started. Okay, from PPE up to this point, we are doing what? We were using carrying amount, and also we have this, the recoverable amount. Now, mathematically, impairment is equal to carrying amount minus your recoverable amount. Okay. Now, the carrying amount, we know how to determine that one. That one is what? Your cost of an asset. So if you have a particular asset, the cost will be here. Then accumulated depreciation. By now, you know the difference between accumulated depreciation and depreciation alone. Okay. So as I've been saying, accumulated depreciation is just depreciation that you've calculated for a number of years. That one is more than 1 year, but depreciation charge is for 1 year alone. So accumulated depreciation, then you will get your what? Carrying amount. Now, what do you mean by this recoverable amount that we've been saying? We are saying that recoverable amount is the higher of, okay, this one is the higher. Higher of what? Is the higher of, now at the end of the day, the entity will like to sell the asset or will want to what? Use the asset going forward. So if you want to sell it, then you should aim at what? Your net realizable value. Okay, net realizable value. NRV. And if you use it to, that one will be the value in use. Okay. So the recoverable amount is the higher of what? These two things here. That's the net realizable value and also value in use. Now, how do you determine your value in use? It's simple and straightforward. It's the fair value of the asset. As I've been saying, we will treat fair value soon when we are done with the asset standards. Okay. IFRS 13, fair value measurement. All right. So fair value of the asset. The question will give you the fair value of the asset less the cost to sell that particular asset. So cost to sell, you will get your what? NRV, that's your net realizable value. What do you mean by this value in use? Okay, this one is the present value of what? We've been doing discounting. So they will give you cash flows, okay, projections for a number of years, let's say 5 years. They'll give you the projection, the cash flow projections. Then they'll give you a discount rate. Then you use that discount rate to discount to present terms. Okay, we know how to do it. Okay, so this one, the PV of all the future cash flows expected to be generated by the asset. We are saying that including its residual value. Don't forget this one. Its residual value. And the residual value is what we know as scrap value. So this is how you determine value in use and what? Net realizable value. Okay, net realizable value. Now you have tricks in determining these things, whether NRV or value in use. So we are saying that the trick in determining the net realizable value, we are saying that always remember the cost to sell in the bracket. So sometimes a question can give you figures for these things, how to determine the net realizable value, and they will give you fair value. Okay, so they will write fair value. Then there will be a figure in the bracket, say 2,000, and they will tell you that the NRV. So you see NRV, fair value, and there will be something in the bracket here. Okay, then they will give you the figure to be 18,000. Meanwhile, the question will mention this 2,000 in the how do you call it, the opening statement, okay, to be the cost to sell. Now, because this cost to sell is in bracket already, this 18,000 here is the net figure, it's already the net realizable value. What I mean is that they've already deducted this 2,000 from the fair value here. So the 18,000 I'm having here is the net realizable value. Because this one is in bracket, don't go and deduct the 2,000 from 18,000 to get what? 16,000. No, it was 20,000 and they've deducted this 2,000 to arrive at 18,000. So mostly, if they want to trick you, they will put the cost to sell in a bracket in front of the fair value or NRV, and they will write the final answer here. So this one is just here to confuse you. If it's in bracket like this, okay, it means that they've already deducted that particular figure. Okay. Now, we're also saying that where the asset has no market value, the NRV is 0. What do you mean by no market value? When there is no active market, okay, where there is no active market. So this one is supposed to be active market. I'll correct that one. So this one is active market. Active market. When there is no active market. So if there's no active market for that particular asset, the question will tell you. So if there's no active market for that particular asset, there is no NRV. Just use your value in use. Okay. If the question states that this asset has no market value or has no active market, okay, the recoverable amount you should use is what? Value in use. Because at the end of the day, you are saying that whatever the figures they give, and they tell you that, oh, the asset has no market value, it means that its NRV is 0 already. The value in use that they've given, let's say they gave you 2,000. You are seeking for the highest between these two. So you just go for this 2,000. Simple. Okay, that is for NRV. Now let's come to how you determine what the value in use. There are some tricks here. Okay, so the first thing is what? Remember to use the future cash flows. It's the future cash flows that we are interested in. Okay, it's the future cash flow we are interested in because that's what we are going to discount to get all the present value. Always use the pre-tax cash flows. Sometimes they can confuse you. They will give you post-tax cash flow and also pre-tax cash flow. Use the pre-tax cash flow. The same way you are using pre-tax cash flow, you should use what? Pre-tax discount rate or pre-tax cost of capital. They will confuse you by giving you post tax cost of capital or post tax rate. Just use the pre. You can see that. Remember to include the residual value in the last future cash flow. Now, if they tell you, they give you projections for 5 years. So year 1, you are saying 2,000. Year 2, 3,000. Year 4, let's say 1,005. Year 3 is 1,005. Year 4 is say 4,000. Year 5 is 5,000. Now, the scrap value, okay, is always recognized or calculated in the last year because it's the last year that you receive in which you receive the residual value or you earn something for disposing of the asset. So if they give you that, oh, this year, that is year 5, excludes scrap value or residual value of 1,000. What it means is that when you get to year 5, add 1,000 to this before you apply you multiply the 6,000 by your discount rate. Okay, so always include the residual value or the scrap value in the last future cash flows. So if the years are 10, the last year, that's what you are going to add the residual value. Sometimes they can tell you that the 5th year's cash flow includes the residual value. That one, they've already added it, so don't worry yourself to do anything there. Okay, so please, up to this point, who is having a question here? Who is having a question here? Okay, no question. I think we are good to go. Last question 1. We are saying that we should determine what the recoverable amount of each asset and the impairment loss for each asset. Yes. So let's pick A. What is the recoverable amount for A?
The recoverable amount for A is 120.
120 because it's the highest of these two. So
Yes, please.
the RA will be 120 for A. What about B?
Should I continue or someone else should? Let me
Yes,
continue.
yes.
Okay, so B is 130.
130. C.
It's 100. That's the net realizable value.
Okay. So please, different persons should tell me the impairment for A, B, and C. Please, today we want to move fast. The muting won't help. So please contribute. I beg. Okay, so please, someone should determine the impairment for these three assets for us. A, B, and C.
Okay, so with the A, there wouldn't be any impairment
Okay,
because the recoverable amount is higher than the carrying value.
that's all. B.
Yes. Then B, the impairment is 20. There will be an impairment of 20. And then C, there will be an impairment of 22.
Thank you very much. All right.
Okay.
How do we identify impairment? Okay. Now we are saying an entity must carry out an impairment review when there is evidence or an indication that impairment may have what occurred. Okay. So we have indicators of impairment. What shows that there is what an impairment, there's a possible impairment. We are having two sources, external and what internal. Now external, we are seeing that one, unexpected decline in the asset market value. So when the asset market value is reducing, then we know that there is what is a possible impairment. Okay. A significant change in the technological markets, economic factors, okay, economical factors or laws and regulations that might have an adverse effect on the company. So if there is new technology, or maybe there are some market factors or economical factors or new laws and regulations that have a negative effect, adverse effect on the company, there is what a possible impairment. So these are some of the indicators of what impairment. You have external and internal. An increase in interest rates affecting the value in use of the asset. You know, when we are determining the value in use of the assets, we discount it using what? The discount rate. So if the discount rate increases, it have what? Effects on that. The company's net assets have a higher current value than the company's market capitalization. Okay. Market. So this one shows that the assets in the statement of financial position of an entity are overvalued. We've overstated their values. Okay. Now, internal sources. This one is within. Evidence that the asset is damaged or no longer of use to the entity. There are plans to discontinue or restructure the operations for which the asset is currently used. Okay, so these are, so this one is just for knowledge sake at this point. I don't think they will ask this in corporate reporting. If they will ask it to be FR. Okay, so let's move on. So we have some additional requirements for testing impairment. So this one is annual impairment. Okay, we are saying that the following assets must be reviewed for impairment at least annually. Okay, so that's per annum, every year. Must test for impairment. When an intangible asset is not yet ready for use. Okay, that the intangible asset is not ready for use. 2, goodwill acquired in a business combination. Okay, so you understand this in consolidation. That one is IFRS 3, business combination. An intangible asset with indefinite useful life. So you go to intangible assets soon after this. So if you have intangible assets with indefinite useful life, so if you talk about indefinite, you know that the useful life cannot be determined. Okay. So there is no limit to their useful life, unlimited. So if you have such an asset, you should test for impairment annually. Now, how do you recognize these impairment losses in the financial statements? Now, you remember the treatment of revaluation differences, where we have revaluation gains and revaluation losses. During PPE, I think I taught you how to treat that one. When you have revaluation gain, you ask yourself if this one is for the first time or if this one is for the second time in respect of that same asset. Okay. Now it's the same thing here. It's the same thing here, not a difference. It's the same thing here, not a single difference. So the way I was teaching you how to treat that one is the same thing you are going to apply here. It's the same thing. So let's see. An impairment loss is normally charged immediately in the statement of profit or loss and other comprehensive income. Okay. So this will depend on whether the assets has previously been revalued upwards. If there is revaluation gain, we know that when there is revaluation gain, we treat it in OCI and also revaluation reserves under the equity component of equity. Now you are saying if you have impairments relating to that same asset, and previously, let's say you've had revaluation gain for that particular asset, you go to the OCI, okay? You go to the OCI and write it off with that impairment loss. We will solve an example, so don't worry. What I mean is that, let's say 2022, you had revaluation gain for asset A. 2023, let's say the revaluation gain was 2,000 Ghana cedis. The next year, subsequent year, that's 2023, you've had impairment loss of 500 Ghana cedis. So that 2,000 you had in the previous year has been recorded under OCI as revaluation gain. So in the subsequent year, that impairment loss of 500 of the same assets, you go to the OCI, you offset it with that 2,000 revaluation gain. So at the end of the day, your revaluation gain under the OCI will now reduce to 1,005 because you've had impairment loss of the same assets. Now, during the treatment of revaluation difference, we said that the revaluation reserve can never be zero. Or sorry, it can never be negative. It can be zero, but it can never be negative. So when you reduce the revaluation reserve or the OCI to nil, to zero, okay, the excess must be debited to the P&L. And I've been saying this, if you hear debit to P&L, you treat it as what? An expense. So if you don't have any revaluation gain with respect to the same class of assets, straight, immediately you treat it in what? P&L as an expense. But if you have revaluation gain previously, you go and subtract it before you bring it there. So that's what we are trying to say. So please, someone should read this illustration too for us so that we just start the calculation, how to treat the impairment differences. Okay.
Okay, illustration 2. An entity owns a property which was originally purchased for 300,000. The property has been revalued to 500,000, with the revaluation of 200,000 being recognized as other comprehensive income and recorded in the revaluation reserve. Sorry. The property has a current carrying value of 460,000, but the recoverable amount of the property has just been estimated at only 200,000. What is the amount of impairment and how should this be treated in the financial statement?
So please, someone should determine the impairment for me.
Okay. So okay.
That's 64.
Hello.
Hey,
You said
260.
so impairment is 260. Yes, any other answer? You agree with him?
Yes, I think so.
You think so? You don't agree with him? Oh, this one is not difficult to. Oh,
Uh, The current value is higher, so yes, it's 260.
Okay. So that's what I wanted to hear. Okay, so the carrying amount, okay, the carrying amount of the asset. This one we are lucky, they've determined it for us. So 460. Okay, here. Less the recoverable amount of what? 2,000.
200,000.
Hey, sorry, 200. Yes, I was writing 260. Okay, so what do we have? You are saying 260. Now, this is the case that the assets, that particular asset, is having revaluation gain of what? 200,000. It's a revaluation of 200 and being recognized as other comprehensive income. The moment you see we've recorded revaluation under OCI, then you should know that it's what? Revaluation gain. You see, they didn't say revaluation loss or what? Gain. But the moment you see that it has been recorded under OCI, just know this. It's revaluation gain. Now, let's do this. Let's do some sketch here. So this is the revaluation reserve. This is the OCI. This is the P&L. So whenever you get gain, revaluation gain, you treat it under OCI, 200,000. Then the same thing will appear under revaluation reserve. Nothing will go to a P&L. Okay. This time around, we have impairment loss of the same assets. And the impairment loss is what? 260. So as we did under PPE with regards to revaluation, the treatment of revaluation differences, this one impairment is 260. So go to OCI and revaluation reserves, take the 200 out, because we say that the revaluation reserve and OCI can never be negative, like they can be reduced to nil, that is 0. So go to, you have 260 here, but I have just 200. Okay, so go to OCI, subtract 200. The same thing will be done under revaluation reserve. The extra 60, you debit it to P&L. It's an expense, so you can put it in brackets or you can leave it. Okay, so this is the double entry. Revaluation reserves is having a credit balance. So if you want to reduce it by 200, you debit it. Okay, so debit revaluation reserve 200. Now you credit, okay, assets. It's having a debit balance, but this one is impairment, so it will reduce the value of the asset. So that one, 260 credits. The difference of 60, you debit it towards P&L as an expense. So this one will be expense. Is it difficult? Is it difficult?
No.
OJ, are you okay?
Hello?
Are you
Hello?
okay?
Please come again with the treatment for me. The treatment.
Okay. My name is Stella. He said it's okay, so please direct us.
Hey, so you said that the revaluation reserve has a credit balance. So the 200, the revaluation, we had a revaluation gain in the question of 200,000. So we would find it in the revaluation reserve as credit and then under OCI. So the impairment loss that we have, it will go and reduce our revaluation gain. But since the revaluation gain is less than the impairment loss, it would absorb all the revaluation gain. So then we are deducting the 200 from the revaluation gain, thereby debiting revaluation reserve by the 200, and then OCI it will reduce by that same amount. Then the difference will go to our P&L. So that is the entry you have done there. So we debit revaluation reserve to reduce our impairment loss, and then we debit the expense that's under P&L with a balance of 60,000. Then we come and credit our assets with the whole 260,000. I don't know
Thank
if I've
you.
explained.
OJ, are you okay?
Yeah, I'm okay.
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 Today, where is
Thank you.
Olivia? All right.
I'm here. I'm in the car.
Okay. All right. All right. So please, Stella, let's move on to the illustration 3.
Okay, illustration 3. On 31st December 2021, an entity noticed that one of its items of plant and machinery is often left idle. On this date, the asset had a current amount of 500,000 and a fair value of 325,000. The estimated cost required to dispose of the asset is 25,000. If the asset is not sold, the entity estimates that it would generate cash inflows of 200,000 cedis in each of the next 2 years. Assume that the cash flows occur at the end of each year. The discount rate that reflects the risk specific to this asset is 10%. Required. Discuss the accounting treatment of the above in the financial statements for the year ended 31st December 2021. And B, how would the answer to part A be different if there was a balance of 10,000 in other components of equity relating to the prior revaluation of this specific asset?
Okay. So the carrying amount is 500,000, right?
Yes.
500,000. Now, what will be the recoverable amount? We have to find a higher of what? Value in use and net realizable value. So first of all, let's look at NRV, net realizable value. Okay, so the fair value of the asset is how much? 325,000. Cost to sell is 25,000. So the
Yeah.
NRV will be 300, right?
Sure.
Now let's look at the value in use. This one, so you bring the year 1 and 2, just 2 years, cash flows, 200,000 each year. Discount factor at what? 10%. We all know how to calculate discount factor. So please, at this juncture, so please calculate it for me. We know it's 1 over 1 plus r raised to the power n, or 1 plus r raised to the power negative n, any of them. So r here is 10%. For year 1, this one will be -1. For year 2, it will be -2. 3 decimal places. Leave it in 3 decimal places. I'm waiting.
So year 2 is 0.980.
3. Okay.
0.90.
Are you sure? Year 2. You're saying year 2.
Yeah, year 2. I'm coming. Let me do it once again.
I'm not getting the same one.
Okay.
Year 2 is 0.826.
Yeah, 0.2826. Ojam, do you have it now?
Yeah,
Okay, you
yeah,
can do it. Okay. So what about year 1? When it comes to present value.
Year 1 is 0.909.
Yeah, so find the multiply it for me. Let's find the product of this and this.
Year 1 is 181,800.
Year 2 is what?
Year 2 is 165,200.
So you see what I was saying? If you have any residual value, you would have added it to the last year. That's year 2. So please find the total.
My total is 347,000. 8,000,
Now
sorry.
let me use this opportunity to introduce annuity, ordinary annuity, and annuity deal. This one is ordinary annuity, so you don't worry about the terms. You use it under leases. Okay. Because the cash flows that the asset will generate in the next 2 years are constant, that is 20,000 each year, you can use annuity. Because imagine this, if the asset will generate constant cash flow of maybe 10 years, 200,000, you cannot do this year 1, year 2, year 3. You repeat this method to the last year. Okay, only if you have constant cash flows. If you use this formula I'm about to write, by the time you finish, someone will still be in maybe year 3 doing the calculations. We now but the disadvantage is that maybe the cash flow in year 2 can be different from cash flow in year 3. That one you cannot use the method I'm about to write or the formula I'm about to write. The formula I'm about to write can be used. Hello? He said,
I'm
OJ.
sure it was a mistake.
Okay, so this is the formula. Ordinary annuity. So that one is how to find a PV in total is 1 minus into bracket 1 plus R raised to the power negative n all over R. You do this, you get the same answer. Just that there will be a slight difference because of what the rounding, because we ended it at what 3 decimal places. So we not get exact, but it will be what equivalent. So if you use this method or this method, the examiner will know that you are correct because of the rounding. All right. So here 1 minus 1 plus, which is 10%, raised to the power negative 2, all divided by what? 10%. So please tell me the value in use. Sorry. Multiply by the cash flow here. Cash flow. So here you multiply by 200,000. Yes. This is the annuity factor. What I wrote first is the annuity factor. Then you multiply by the cash flow, the constant cash flow. All right. So multiply by 200,000. So what do you have?
I had 347,007.438.
438.
107.438.
So let's leave it at 107.
Um,
If you can bring it at the 2 decimal places, 0.43. So you see, this one is 347,000. This one is 347,107. The difference is as a result of what the rounding. So as I said, if you have constant cash flows, just use this simple method. Okay. Now we've determined our value in use to be 347,000. NRV is 300,000. Which one is the highest? Definitely value in use, 347. So our recoverable amount will be the 347. Okay. Our recoverable amount will be the 347. Okay. So carrying amount, we are still on A. 500,000. Recoverable amount, the highest. So 347. So please, what is the impairment loss?
$153.
Yeah, correct.
So that's just for B. Okay. Now you have this. The double treatment is simple. Okay. The journal entry is simple. Assets are having debit balance. So if they are reducing, you just send it to the credit side, because the impairment will definitely reduce the value of the assets. Okay. So you will credit assets, the impairment amount of 153. This one is when the asset has been impaired for the very first time. Then you debit P&L. Expense 153. Simple. Let's look at the B. They are saying B, that one, there was revaluation gain in OCI. Okay. Another component of equity. So it's the same thing, to be shown under OCI. Prior revaluation of this specific asset. So it should be the same asset. It cannot be asset A, then use asset B's own to offset. No, it should be asset A, asset A. So of the same asset. So this one, there is 10,000 in revaluation gain. So please, who can give me the double entry? Okay, based on what I wrote here. This one, what Stella explained here. Someone should give us the treatment. Or you say debit the revaluation reserve, debit P&L, credit asset. So the same thing here. We are saying this time around, we have 10,000 balance in the revaluation reserve. But this time around, our impairment is what? 153, as we've determined here. A is when the asset has been impaired for the very first time, and there was no revaluation gain with regards to the asset. Okay. But with this one, there is a impairment loss of 153. But also there is revaluation gain of 10,000. So please, you can tell me what the double entry will be.
So the revaluation gain will reduce our expense by 10,000. So for the debits, we split it into two, unlike in the E. So for the debit side, we debit our revaluation reserve by absorbing all the 10,000. Then we debit the balance, that will be 143 to expense, and then credit the total 153 to our asset.
So, please, do you understand? OJ, I hope it's fine.
Yes.
Good. So now illustration 4. Stella, please, illustration 4.
Okay, illustration 4. So we have a cash flow, pre-tax cash flow, post-tax cash flow, and then the date year end. Then the pre-tax discount rate for the plant is 8%, and the post-tax discount rate is 6%. Required, calculate the value in use of the plant.
Okay, so this one, the cash flows are not the same. So you cannot use the annuity. So what depreciation, what cash flow are you using and what rate are you using?
Pre-tax.
Okay. One thing that I forgot to say is that, okay, so the pre-tax rate is what? 8. Okay,
Yes.
8% at 8%. One thing I forgot to mention is that, you see, the pre-tax cash flow, sometimes the ones here will be determined after they've deducted depreciation. Sometimes they will give you pre-tax cash flow. Okay. And this cash flow will be after they've deducted the depreciation. So that one, they will add the depreciation charges for the various years. Here, they will bring their column. So let's say they will bring depreciation. This one is an assumption. Oh. Here is 2,000. Here is 1,000. Here is that. Here is that. So what you are going to do is that if you are writing the cash flow here, add the depreciation back. So for the first year, the cash flow will be 10,000. That will be the pre-tax cash flow plus the depreciation. That's just an assumption. So always add the depreciation if the cash flow that were determined that was determined after the cash flow there. Okay, we have this cash flow after they've deducted the depreciation. So anytime you are choosing the cash flow, just ask yourself if they deducted depreciation. If yes, you add it back. They can trick you, they can bring depreciation too. And the cash flows here will be the depreciation inclusive. So the depreciation column will be there to confuse you. So just look at the statement. So they will indicate whether depreciation is part or this one is exclusive of all depreciation. Okay, so let's take. Okay, so yeah, 1, 2. I want to write the years, but because of space, I'm not get chance. So you let me use 1, 2, 3, 4, 5. So 2018 will be year 1, year 2, year 3, year 4, year 5. The cash flow here is 8,000. Please, the discount rate, make it a discount factor. Provide it for me, please. 7,000, 5,000, 3,000, 13.
The first one is 0.926.
Second. So just
Zero,
clear the exponents and write to the the calculator.
0.857. 0.794. 0.735. And 0.681.
Yes. So find the multiplication. Ojam, please help. We want to finish the 2 standard.
Yeah, it's correct.
No, the product. Multiply this so that we get a present value.
Okay. So the year 5 is 8847.58.
Year 5 is what?
8847.58.
I'm getting 8853.
Year
I use
one
all
is
the distance.
year one is 7408.
So Jam, let's calculate it as we see it on the board.
Okay. Year 4 is 2205.
Okay, Stella, you were saying something.
Year 2 is 5999.
Year 3.
Year 3 is 3995.
3.
995.
And you used all the figures.
Yes. No, I use only the 799. 0.799.
And it's 3995.
794.
Or it's not correct?
It's 0.794.
Yeah, so it's 3970.
Am I getting the same? So let's add it to get a value in use.
Yes, it's correct.
Okay, so please let's add it to get a value in use.
Okay. $28,435.
Correct.
Okay, thank you very much. All right, let's move on to illustration 5. Am I moving fast? Because I see these ones to be the basic. And trust me, this is what they will be bringing. But if you don't know the basics, you wouldn't be able to solve it. So please, are you okay, or I'm moving at a faster rate? Are you okay? Is the speed okay or is abnormal?
It's okay. It's the punching that is delaying.
The calculator.
But it's fine.
And that one too, you have to work on it. Because
Mm,
speed, okay.
all
All right, so
right.
take the illustration 5 for us.
Illustration 5. Sir Charles Timber Limited produces and exports lumber. Oh, sorry. Produces and exports lumber and planks. It owns a plant which has a book value of 1.8 million cedis as at 1st January 2010. The government of Ghana passes legislation that restricts the exportation of lumber. Consequently, CTL has to reduce production by 40%. The cash flow forecast for the next 5 years, included in the budget submitted for management approval in January 2010, shows the following. So we have 2010, 11, 12, 13, and 14, and their respective cash flows. The cash flow forecast for 2012 includes expected proceeds, that's 60,000 from disposal of the plant. The cash flow projections also ignore the effect of general upward movements in prices. It is estimated that if the plant is sold in January 2010, it would realize net proceeds of 1,320,000 cedis. The cost of capital for CTL is 15%, ignoring inflationary effects. Calculate the recoverable amount of the plant and impairment loss, if any.
All right, thank you. So if you take a clear look at this, you see that this one, there was what? An external indicator. Okay, because we said that the external indicators, where are they? Okay, factors, laws and regulation that have an adverse effect. So here, the one having an adverse effect is what? The introduction of this legislation that restricts the exportation of lumber. Okay. So first of all, the carrying amount was given. So as we determine in P&L, we said that carrying amount is the same as net book value. So the book value here is what? Our carrying amount. So carrying amount is 1.8 million. Okay. So let's determine recoverable amounts. Now they've given us NLV. So please, you can tell me the NLV here. Hello. Net
Hello.
realizable value.
Is 1,320,000.
Good. Now you have to determine our value in use, which we don't know. Okay. So let's determine the value in use. We have the year, cash flow, discount factor at 15%. PV will come. Okay. So here we have 2010, 2011, 2012, 2013, 2014. Cash flow, we have 552,000. 506, 376,000 for 2012, 250 for 2013, 560 for 2014. There was something here. The cash flow forecast for 2014 includes expected proceeds, that is the residual value of 60,000 from the disposal of Ford plant. If they changed this word and made it what excludes, then the 60,000 here will be added to that of 2014. So at the end of the day, we will be getting 560 plus 60,000. That will give us 620. But this 560 includes what? The proceeds. So they've added it for us. So please, the discount factor is at 15%.
0.870.
Thank you. Still, I'll be doing the product for us. Ojam, please take the discounting for us.
0.756. 0.660.
Which one?
That's the third year.
24.
Yes, 0.660.
Check it again. That one, check it again.
PV for the first year is 480,240.
Really? Okay. So 0.58.
658, yes. Okay,
658. Sorry.
The second PV is the second PV is 382,536.
Discount factor 0.572.
Thank you.
The third PV is 247,408.
0.497.
$143,000.
And the last one is 27,8418.
You added everything.
Yes, I use everything.
It's 278,320.
Okay.
Thank you. So let's find the sum to get a value in use. So in examination, the cash flow, don't forget to bring the CD sign, the same as this. Don't forget it. Okay. Sum.
$1,531,504. Please double check. One. 1,531,504. Yeah.
Okay.
Yes.
So now we can move on to find our impairment. So now the question was like determine the recoverable amount. Okay. Now the carrying amount, as we have in the question, so at 1.8 million.
Yes.
And the recoverable amount is the higher of value in use and net realizable value. So what will be the recoverable amount?
1531504.
Thank you. So there is impairment loss because carrying amount is greater than what recoverable amount. But if recoverable amount is bigger than carrying amount, just write dash. You don't have impairment gain. Okay.
268496.
268
Try.
496.
Yes.
Okay. All right. So we have another subtopic here: reversal of impairment loss. Reversal. So reversal of an impairment loss. What does it mean? Okay, so we know this impairment losses. Okay, we have certain indicators of impairment losses. Now, impairments reduce the value of the assets. The impairments reduce the value of the assets. Now, these are the indicators. When there's a decline in the assets market value, when there are some technological, economical, market laws and regulations that have what? Adverse effects on the company. When these things happen, it reduces the value of the assets. And we know that if the calculation of impairment is based on what? The predictions of what may happen in the future. That is why we use future cash flows. It is based on predictions of what may happen in the future. Now, the cash flows, they are what? Projected cash flows for the future. Okay. Sometimes the actual event, the one that we project, at that time, the actual event might or turn out to be better than the one we predicted. So if we predicted 5, the actual one might end up what, 6 or 10. If this happens, the recoverable amount is recalculated and the previous write down is reversed. So what we mean is that we said some of the indicators are maybe a reduction of the assets market value, in a reduction in the assets market value. What if the opposite occur? So you've calculated impairment due to one of these indicators. Subsequently, it changed, okay, for the better. So here, the market value of the asset increased. So that thing or that indicator causing us to calculate impairment has changed for better or has changed for good. If this happens, we are saying that we should calculate that impairment that we've deducted and reverse it. And how are you going to do that? How are you going to do that? We are saying that if this happens, then recoverable amount is recalculated and the previous write-down is reversed. 1, the impaired assets should be reviewed at each reporting period, reporting date, to see whether there are indications that the impairment is reversed. So at the end of every year, the same way you are checking for impairment, you should also check whether there are some indications that, oh, this asset is now doing well. So that impairment we calculated, we should reverse it. The second point is telling us that a reversal of impairment loss is recognized immediately to the profit or loss. So the moment you reverse impairment, now impairment loss is treated as an expense. That is when it's not having any revaluation gain. So if we treated it as an expense, then if we are reversing it, we have to treat that reversal as a gain or as other income in the P&L. When you get your gross profit, you add other income. Maybe we term it reversal of impairment loss. Reversal. If the original impairment was charged against the revaluation surplus, that is in OCI. That one, you go to OCI, you add it back. Okay, like the ones we've been doing. If you deducted 10,000 from the revalue OCI in the name of impairment loss, now we are reversing it. So you have to add that 10,000 you deducted back. And you are saying that the reversal must not take the value of the asset. All these are rough. So you forget about this one. Let's come to the work itself. Let's talk about this one before we go to the indicators. An impairment loss recognized for goodwill cannot be reversed in the subsequent period. Okay, so goodwill, intangible assets, you go to goodwill and you understand why we are saying that any impairment that that the loss has been recorded, I mean the impairment loss has been recorded already in the P&L. Subsequently, you cannot reverse what the impairment loss for goodwill, because once you purchase goodwill, okay, once you purchase goodwill and that goodwill you purchased become impaired, any improvements, okay, or any increase in their recoverable amount is likely to be increase in internally generated goodwill. So we go to IAS 38. I wouldn't bother you much on this. And we are saying that any internally generated intangible asset or goodwill can never be what recognized. Therefore, its impairment loss can never be what recognized, and also we cannot reverse the previous impairment loss. So this one you understand it better when we are treating the next standard, IAS 38, relation with goodwill. Okay, so indicators of impairment reversal. So this one I will tell you this one is the opposite of what? In indicators of what? Impairment. This one, indicators of impairment, we have external, these ones, okay. These points we have the external. So whatever you see here as an indicator of impairment, the opposite should be the indicator of impairment reverse, okay. So let's see the first one. We are seeing that indicator of impairment, first one, external source, an unexpected decline in the asset's market value. Let's look at the opposite, and the opposite will cause the reversal. The opposite is here. Increase in its in the asset market value. You see the first one, the indicator here, it was what? Decline, a reduction in the asset market value. So subsequently, if it increases again, then there is what? Reversal. Okay, we must do the reversal. Favorable changes in the technological, market, economical, or legal environment. Previously, it is what? The adverse ones. Because you are saying that have an adverse effect. So if you have favorable one, then you have to reverse the impairment. Decreases in interest rates. Initially, it was increases here, the third point, an increase in interest rates affecting the value in use of the asset. So whenever that that rate we are talking about decreases, you do what? You do impairment, reversal of impairment. Now, this is how you are going to treat the reversal of impairment, or this is how you are going to calculate it. You first of all determine the carrying amount. This carrying amount is with impairment. So determine the carrying amount with what? Impairment. Step 2, you determine the carrying amount of that same asset carrying amount of the same assets. This time around without impairment. The same asset too. So the first one, you look at the information given, the impairment, whatever is given about impairment, you use it to determine the carried amount as at the date that the question requires you to determine the recoverable amount or the carrying amount, or determine the impairment loss. Step 2 is you determine the carrying amount of the same asset without what? The impairment. So this one, the step 2, you just do cost minus accumulated depreciation. So step 2 is simple. Step 2 will be the cost, okay, less the accumulated depreciation. But step 1, sometimes because of the impairment losses, the river, maybe you might see revaluation and all that. So it might cause some trouble a bit, but you understand, okay? You do it in such a way that it will be favorable to us. Okay. And the last step is you find the difference, okay, of the you find the difference between the carrying amount with impairment and also carrying amount without impairment. And the answer will be the maximum amount you can reverse. You are doing reversal, so we are looking for the reversal amount, and that's the maximum one you can make. All right, so it will be the maximum reversal. Okay, will be the carrying amount with impairment. Sorry, without. The first one is without, because that one will be the biggest amount. So without impairment. So you punch the step 2 first, minus carrying amount with impairment. The answer is what you are going to reverse. And if you are reversing, the double entry is simple. Okay, the double entry is simple. Initially, you were saying that if an asset, you check for impairment and you get 1, you credit the asset, you debit P&L. Okay, so this one is just the opposite. Initially, we were crediting assets, so this one you debit assets with a reversal. Okay, reversal amount. Then you credit P&L with the same reversal. If I say credit P&L, you are treating it as what? Income. You are treating it as what? Income. And if there is a revaluation, remember, you go to the OCI and add it there. You will not treat it under what? P&L, because maybe you deducted from OCI. So it depends on the question. So please, do you understand before we pick the illustration 6? You understand? Hello?
Yes, please. I'm okay. I understand.
Yeah, sure. Confuse you, man.
Yeah. The only confusion is when you calculate without, you subtract the one without impairment from the one from impairment.
Yeah.
But that's okay. Yeah.
Yeah.
I thought it
So
could have
that is
been
the amount you are
one
going
with
to reverse.
Okay.
Are you talking about how we are going to determine the amount?
No, yeah, I was thinking that you'll have the one with impairment, the amount with impairment minus the one without impairment. But it's the other way around. So it means that our answer will be a negative answer.
If you do it that way, it will be a negative answer. Okay. So here is the without first minus with. So the carrying amount without impairment. So if we have no impairment, what will be our carrying amount? And now that we are having impairment, what is the carrying amount? Then you subtract with impairment from without impairment. So are you okay? Are you okay?
Sure.
Okay,
Yes.
so please, Stella, kindly read for us illustration 6.
Okay. Illustration 6, reversal of impairment. Hitler. Hitler purchased a non-current asset on 1st January 2011 at a cost of 30,000. At that date, the asset had an estimated useful life of 10 years. Hitler does not revalue this type of asset, but accounts for it on the basis of depreciated historical cost. On 31st December 2012, the asset was subject to an impairment review and had a recoverable amount of 16,000. At 31st December 2015, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable, with the results that the recoverable amount is now 40,000 required. Explain with supporting computations the impact on the financial statement of the two impairment reviews.
Thank you. Okay, so first of all, let's determine the without first, because mostly on our calculation. Okay, so we are going to determine the carrying amount without with impairment. Sorry, so we are going to treat the step 2 here first. Sorry, the step 1, determine the carrying amount with impairment. So yes, as we have it here, so carrying amount with impairment. So the cost of the assets was 30,000. And the asset was acquired on which date? 1st January 2011, right?
Yeah.
And the next thing you should ask yourself is that, is there any revaluation, and when was that date? Looking at this question, we are seeing that Hitler does not revalue this type of asset, so there's no revaluation. Now, you ask yourself, where can we find the recoverable amounts and at what date? Okay, so here the asset was subject to impairment review. Maybe there was an indicator, whether external or internal. Okay, and they tested for impairment, so they had impairment. Okay, they wanted to calculate for impairment. So that date was 31st December 2012. Please, have you seen it? This one.
Yes.
Okay. So as at this date, the recoverable amount is what? 16,000. So as we know, like the way you treat depreciation, charge depreciation to the date that you have your carrying amount, because you purchase the asset in what? 1st January, on the 1st of January 2011. The recoverable amount of 16,000 is on 31st December 2012. So how many years later do we have this recoverable amount after the acquisition date?
2 years later.
2 years later. Good. We bought it on 1st January 2011. So it was the whole of 2011. And also we have the recoverable amount at the end of 2012. So the whole of 2011 and the whole of 2012. So 2 years. So you calculate you determine your carrying amount as at that date. So here it will be accumulated depreciation, not just depreciation, because it's more than 1 year. So that one will be 30,000. The useful life of the asset is how many years? 10 years. Here, 10 years. Okay. By 2, the accumulated years. So what do you have?
6,000.
That 6,000. Okay.
Yes.
So what will be the carrying amount as at the 31st of December 2012? 24,000, right?
Yes.
Yeah.
Okay. We will bring our recoverable amount. Okay. We will bring our recoverable amount. and that is the end of 2012. It was 16,000. So there is an impairment of what?
8. Oh,
Yes, so
That's
impairment of
8,000.
8,000. Yes.
Good. Now, they said that, so this one is 31st December 2012. Now, do you agree with me that this is what you are going to recover? That's what you are going to use, recoverable amounts, as 16,000. This one is 31st December 2012. So will you agree with me that it can be the carrying amount as at 1st January 2013, the 16,000? Do you agree with me? Sorry.
Yeah.
Going concern. Okay.
Yes.
So we are using the recoverable amount, not the carrying amount. So don't record the 24,000 here. It's the 16,000. Okay. Now, you ask yourself whether there was any indicator of impairment, or this indicator is what for reversal. Now, per the question, the indicator that we are having here is what? A reversal one. So you ask yourself, when was that? You are saying that at the end of 2015, that's 31st December 2015. So the carrying amount that we have here, or from this place, okay, from 31st December 2012 to that 31st December 2015, how many years will it be?
3 years.
3 years. So you have to determine the accumulated depreciation for that 3 years. Okay?
Okay.
Good. So accumulated depreciation. I want to show you something here.
Okay.
Now, look at this. Recognizing impairment loss under this, we are saying that the recoverable or impaired amount of the asset is then depreciated or amortized over its remaining useful life. So because of this point, that is why we are using the 16,000, because that is the recoverable or impaired amount, not the carrying amount. They didn't say carrying amount. They said recoverable or impaired amount. Is depreciated or amortized. What do you have depreciated or amortized? Depreciated because this one is for tangible assets, and amortized is for intangible assets. We are here to treat intangible assets, but this is just introduction. We depreciate tangible assets and we amortize intangible assets by the same calculation. And that of natural resources is what? Depletion, taxation. So that's just by the way. So one will ask, why are you not using the carrying amount as at this date? No, we are using the recoverable amount. Okay, we are using the recoverable amount as our carried amount, because it will be carried as that recoverable amount. Okay, over its remaining useful life. So here, the carrying amount now becomes 16,000. Don't use the cost of 30,000 again. No, 16,000 divided by remaining useful life. Okay, now it was 10 years. 2 years has elapsed. So how many years do you have?
8 years.
Yes, 2 years have elapsed. So we have just 8 years. Okay, n minus 2, 8 years. That's the remaining useful life. Times its accumulated depreciation. We said it's 3 years. From this date, the date that there was a reversal, indicator for what? Reversal. Okay, so this one too, what do we have here?
6,000.
Now, what to be our carrying amount as at 31st December 2015?
10,000.
This one is what we are looking for. This one is the carrying amount with impairment. With impairment. Okay, this one is what we are looking for. The 10,000 is what we are looking for, but we have a recoverable amount of 40,000 for that year. Okay, for that same asset. 40,000. So now, if you are recognizing it, it won't be the 10,000 to be 40,000. That is just by the way. But this was the main reason why we went through all these steps. Okay, now we are done with the first step. We've determined the carrying amount with impairment. Now let's determine the carrying amount of the same asset without impairment. So this one is simple and straightforward. This one is, we assume there is no impairment, and they said that Hitler does not use what, the revaluation model. They use the cost model. Okay, so that one, carrying amount without impairment. If there has not been any impairment, what will be our carrying amount? So this one is simple. So the cost of the assets, that one 1st January 2011 was 30,000. Less the accumulated depreciation. And one will ask, how many years are you going to use? So this one over useful life of 10 years. Accumulated depreciation. So accumulated years, how many years? We bought the assets in 2011. And the last date, or the date that reversal occurred, was on what? The date that reversal occurred was on 31st December 2015. So from 1st January 2011 to 31st December 2015, the date that the reversal occurred, or there was indicator for reversal, and also the date that we purchased the asset. How many years do you have in between this period?
5 years.
Thank you. So the whole of 2011, 1, the whole of 2012, 2, the whole of 2013, 3, the whole of 2014, 4, the whole of 2015, 5. Times 5 years. So please, what do you have here?
That's 15,000.
So our carrying amount without impairment is what? So this one is 31st December 2015. 15,000. Okay, 15,000. So the maximum impairment reversal, the maximum amount we can reverse is what? Carrying amount without impairment is this one, 15,000. Carrying amount with impairment, 10,000 here. So the maximum amount you can reverse is 5,000. Double entry is the opposite of what? The impairment loss. So you just debit assets. You are correcting the impairment. So this is the maximum amount you can what? Reverse, 5,000. You credit P&L, 5,000. Please, do you have any question here? Do you have any question here? Hello?
No, please.
Stella?
Yes, Pa, please, can you go over the maximum where you had the difference?
So please look at this statement and tell me if you have any confusion here. Look at these steps. Look at these steps. 1, 2, 3. So read it. Read it.
Okay, so 1, determine the carrying amount with impairment.
So that
2,
one, are you okay with that?
yes, please.
And what is the amount we got for that one?
The one we got is 10,000.
Okay.
Then
Well,
2, determine the carrying amount of the same assets without impairment. That's cost less accumulated depreciation. And we had 15,000.
okay.
Then maximum reversal. That's carrying amount without impairment, less carrying amount with impairment.
So that's why we have 15,000 here. This is the maximum one we can revert because we saw something here and I said they are all brothel. Here, the reversal must not take the value of the assets above it. Okay, above the amount, the reversal must not take the value of the asset above the amount it would have been if the original impairment had never been recorded. The depreciation that would have been charged in the meantime must be taken into account. So that is why we determine depreciation and all that. So this is the reason why we can only reverse 5,000. So we cannot reverse more than 5,000. That is what we mean by maximum impairment reverse. In subsequently, this amount is what you are going to reverse.
Okay.
So are you okay here?
All right.
Yes. So when we are done and I send the documents, you go through. You know, sometimes these are laws, the standards. Some will make sense, some at instance it will not make sense, but when you sit down and revise, it will be okay. Okay, so let's go to another subtopic called cash generating unit. Cash generating unit. CGU. Okay, CGU. What do you mean by CGU? Cash generating unit. So first of all, let me use my diagram to summarize everything that is here. We are saying that it is a group of assets that produce single independent cash flow. So we are saying that as a basic rule, the recoverable amount and carrying amount impairment is mostly calculated for assets individually. So asset A, asset B, asset C individually, then you calculate for them. But there are some occasions where it will not be possible to estimate such value for an individual asset, particularly in the calculation of value in use. This is because the cash inflows and outflows cannot be attributed to one user. So the generation of outflow, cash inflow, and also the outflows can never be attributed to individual assets. So if you want to determine recoverable or value in use for one asset, it can never be possible unless you calculate it for as a group. Then you allocate it to what? Individual assets. So basically, that's what CGU means. So we are saying the IS36 defines CGU as what? The smallest identifiable group of assets that generate cash inflows that are largely independent of the cash inflows from other assets. So they don't produce, collectively, produce cash inflows. It's independent of the cash inflows from other assets. So as a group, generate assets, they are independent, okay, and they are separate from the other assets. That's why I said it's a group of assets that produce single independent cash flow. Now, another point I want to reflect on is that the CGU, that's the cash generating unit, this smallest identifiable group of assets, in total do not reflect in the statement of financial position or the financial statement. So the CGU in total is not reflected in the financial statement. So you cannot see the CGU, their carrying amount 50,000. Then you go into the balance sheet, the statement of financial position. I'm looking for CGU. You see their value 20,000. No, you can never see them in total. Rather, the individual assets and liabilities within the CGU are recognized separately in the statement of financial position. In the SOFP. So as I said, you cannot go to the statement of financial position and start looking for what CGU. No, but rather you have the individual asset and liabilities, okay, recognized separately in the statement of financial position. Now, we are saying that impairment is calculated for the whole CGU. Okay, impairment is calculated for the whole CGU. So impairment is calculated for the whole CGU. Cash generating unit. Why? Because it's impossible, okay, or impracticable to calculate the impairment for the individual asset within or in the cash generating unit. So you determine the impairment for the group as a whole, for the cash generating unit, for the unit as a whole. Then you allocate or apportion the the impairment to the individual items. Okay. All right. So you calculate for the group as a whole and allocate. Okay. Allocate. So you allocate the total impairment that you determined for the unit, the whole unit. You allocate that total impairment to the individual items. This one, I don't know why people find it difficult, but it's very simple. This one is very simple and straightforward. Okay, so the cash generating unit is a group of assets that produce single independent cash flow. And this CGU in total do not reflect in the statement of financial statement. So you cannot see it on the face of all, the statement of financial position. No. Rather, you see the individual assets and liabilities within the cash generating unit. Okay, that are recognized separately in the balance sheet. Impairment is calculated for the group as a whole, for the unit as a whole, because it is impossible for you to calculate the impairment for each item within the cash generation unit. Okay, within the cash generation unit. Then you allocate the total impairment you determine for the unit as a whole to the individual items. So we are saying that the impairment calculation is the same thing we know for the individual items. So we are saying that the current value of the CGU should be greater than what the recoverable amount that you get your impairment for the unit as a whole. So the current value of the CGU means what? The current value of all assets in CGU added together. So you have a number of assets in the CGU, you add their current values. They will give you the recoverable amount of the unit. You will check if the current amount is greater than the recoverable amount, then you know what? There is an impairment. Now, this is how you are going to apportion or allocate the total impairment to the individual items. We have steps. Now, the steps are very important. So this is where people see it to be difficult. So you just have to sit down, master the steps. That's all. It's not difficult. First of all, you take out or you allocate to any asset destroyed, damaged, that is valueless, useless, or worthless. Okay. So you find any asset that is destroyed beyond repairs, damaged, valueless, it has no value again, it's useless, it's worthless. Okay, so that one you take it out. 2, to any unimpaired goodwill. So if there is no any asset that is destroyed beyond repairs, that is damaged, valueless, useless, or worthless, you move on to what? Unimpaired goodwill. So whenever you have goodwill in the cash generation unit, you allocate the full amount of the cash of the goodwill to what? You allocate, let's say you have goodwill figure to be 5. When you are allocating the impairment to goodwill, you allocate the whole 5. So first, you check out for what? Any asset that is destroyed, damaged, valueless, useless, or worthless. 2, you find any goodwill or unimpaired goodwill. Okay. 3, to any intangible assets that has no market value. To any intangible asset that has no market value or it has no active market. In other words, to any intangible assets that is having a nil or 0 net realizable value. 4, to any asset whose net selling price, whose NRV is less than what? Their carrying amount. So if you have an asset and you check the net realizable value or the selling price you have in the question, it's less than their carrying amount, you guess what? Take that one too. Then finally, to all the assets remaining on pro rata basis. So you solve example and you will get to know what the pro rata basis means. No individual asset should be written down below the recoverable amount. So as we did with the rest, so this one too, there should be no individual asset that will be written down below the recoverable amount. So there is no individual asset that the impairment should be more than their recoverable amount, because we are going to allocate to what their we are going to allocate the total impairment to the individual items. So why will we have an asset, okay, a single asset, that their impairment is more than their recoverable amount? No. So let's take note of that one. So these are disclosures. These are for reading purposes. So what would they disclose at the end of the day? Okay, so we have illustration 7 on the cash generating unit. Okay, on cash generating unit. So please, any question with respect to the cash generating unit before we try some 3 questions on it? Yes, any question? Hello. Okay, so please, Stella, can you read for us?
Illustration 7, cash generating unit. A company runs a unit that suffers a massive drop in income due to the failure in its technology on 1st January 2018. The following carrying values were recorded in the books immediately prior to the impairment. We have goodwill, technology, brands, building, land, other assets. The recoverable value of the unit is estimated at 85,000. The technology is worthless following its complete failure. The other net assets include inventory, receivables, and payables. It is considered that the book value of other net assets is a reasonable representation of its net realizable value required. Show the impact of the impairment on 1st January.
Okay. One thing I forgot to add is that note. Do not allocate to these individual items. So do not allocate impairment. Okay. Do not allocate the total impairment of the unit to the following. So do not allocate to this. So one, we have current assets. So do not allocate. So if you have any current assets, that one is not part. Two, liabilities. So take note. So this one, the other assets. Okay. They say that the other net assets include inventory, receivable, payables. So that one, it falls here. So this one will not be what part of our calculation, or will not be part of the apportionment. You will not allocate total impairment to this other net asset. Take note. So this is what you are going to do. This is what you are going to do. You bring a schedule, okay? And that one will be assets. So you write assets. This one should clean the lines. Okay, so we have assets in the unit. Okay, you have the assets. You have the carrying amount. You have impairment. Okay, then you have your carrying amount after impairment. Okay, so this one is carrying amount before impairment, then carrying amount after impairment. So we have assets. Let's first of all write their carrying amount. So goodwill, technology, brands, building, land, other net assets. So the carrying amount of goodwill, examination condition, don't forget to bring the CD sign. It's very important. So goodwill, we have 20,000. 5,000 for technology, 10,000 for brands, 30,000, 50,000, and 40,000. So this one is 50,000, not 50,400. So please, let's find the total. Okay, let's find the total. Find the total for me.
All 5,000.
All right.
So we are okay. Thank you. So we are saying that impairment cannot be calculated, or it is impossible. It is impossible to calculate the impairment for the individual asset within a unit. Therefore, we will find the impairment of the what unit as a whole. Then we allocate to the what various units. Okay. You allocate to various what assets. All right, individual assets. So let's see. The impairment of the unit is what? The carrying amount of the whole unit is 155,000. That's the total. Minus what is the recoverable amount of the whole unit?
85,000.
5,000. So that one will be our total carrying amount after impairment. So 85,000. So that will be, if you add this 85,000, if you add the current amount you're about to determine, the total should give you this recoverable amount. That is why they said no individual asset should be written down below its recoverable amount. Okay. Now, what is the impairment for the unit as a whole?
70,000.
70,000. Thank you, Senior. So this 70,000 will be, so okay. So this 70,000 will be the impairment total of the unit, because it's the whole unit. So this is what we are going to allocate, or we are going to apportion to the individual asset. So first of all, I made clear, I gave clear note here that do not allocate to what? The following: current assets, liabilities. And we are saying that the other assets includes those things. Okay, it was current liability, current asset, and also payables. That's a liability. So this one will not get a share of the impairment. So its current amount after impairment, or its recoverable amount, will still be the 40,000. Okay. Now we are going to use these steps to allocate the impairment. Already net assets, that's current assets, payables, is not part. Okay. So what is the first step saying? I want us to contribute for you to understand it once and for all. What is the first step saying? Hello.
Yeah, so
Okay,
it's saying we
okay.
should. So any asset that is destroyed, damaged or valueless or
Now,
worthless, we'll write it off.
in the question, do you have any assets that's damaged, worthless, spoiled beyond repairs in here? Do you have any assets like that?
Yeah, technology.
Technology. So that's the first one you take out. So the whole 5,000 will be out. So 5,000. Okay. The whole 5,000 will be out. So the current amount after impairment will be dash or zero. Let me write 0. So you allocate the full amount of that asset that is useless, valueless, worthless, or damaged, okay, or spoiled beyond repairs. You allocate the full carrying amount before impairment to that impairment. Okay. What is the step 2 saying?
To
Please,
any
what is the step?
unimpaired good,
So you just
unimpaired
look for
goodwill.
look for goodwill. So please, what's the goodwill in this question? The amount 20,000, right?
Yeah.
So the whole 20,000 of the goodwill to be out. You get 0 here. Now let's look at this. We are saying that, so here we don't have any intangible assets that has no market value, because the brand here is what? It's an intangible asset. But let's see if it's having a 0 market value. Where is it? Where is it? Okay, they didn't say anything about it. So it's what? It's having a market value. If they say that, oh, this brand is having no market value, that one too, the brand will go up, the whole 10,000 will go up. But they didn't say anything about it. Now the net asset here is not part, because we say that we do not allocate total impairment to current assets and also liabilities. Okay. So now we are left with brands, buildings, and land. We are left with these 3 assets. The total assets, total impairment is what? It was 70,000. Now you've taken out 2. So summation of 20 and 5 will give you 25,000, right? Hello.
Yes.
The total
Yes.
impairment is 70.
Yes.
Total impairment is 70. Total impairment is 70. Now, we are saying that based on the steps, we've taken out goodwill. We've allocated the whole amount to technology, 5,000, and the whole amount of goodwill as impairment because we should write it off based on the steps here per the standard. Okay. So the total impairment is 70. Now, we've taken 25,000 out of it. So, what will be the, let me rewrite this out, impairment.
25.
Okay. So we are going to allocate just 45,000. Okay, so you are going to allocate just 45,000. Please, are you okay? Don't get confused. Oh, it's simple. Okay, if you are confused, let me go back and explain it again. So the thing is 70,000. You've allocated 20,000 to goodwill, 5,000 to technology. So it's left 45,000 for you to allocate or apportion among brands, building, and what? Land. So this is what you are going to do. Find the total of these three assets left. Find the total and do it on pro rata basis. And that's what we are coming to do here. So you take brand, you take land, you take building. Okay. So let me do it like the way they've presented it. So it was brand, building, and land. So brands, building, land. Less land. So add the total of the two. Okay, so let me do this. So it will be 10, 30, 50. So 10,000, 30,000, 50,000. So please, what's the total for the three assets remaining? Because we are seeing that finally to any tangible assets remaining. So these are the assets we have: building, land, and what? Brands on pro rata basis. So that's what we are doing, pro rata basis. So let's find the total. Yes, fast.
90,000.
90,000. Thank you. Now the whole thing we are coming to allocate to them 45,000. Okay, the whole thing is 45,000. Okay, so this is how the pro rata basis will be. So for brand, it will be the 10,000 by their total amount of 90 times, let me just cut off 3 zeros. Okay, when we are writing it here, we just add the 3 zeros because of space. So it will be the 10,000 divided by the total of 90 times 45,000 here. Okay, this is the total amount. Building 2 will be 30,000, its amount over the total 90 times 45. Land will be what? 80. Is it A? And what? 50. It will be 50 over 90 times what? 45. So let's write their figures here. Yes, please. What are you having here?
We have 5.
So 5,000.
15. And 25.
Okay. So let's go and do that. So 5,000 for brand. So brand, you go here. Brand will take what? 5,000. So minus 5,000. So the current amount or the recoverable amount will be current amount after impairment, or the recoverable amount will be 5,000. Now the building will take what? 15,000. So you take out 15,000. You get 15,000. Right? You get 15,000. Okay. Then this one, land will take what? 25. At the end of the day, when you add everything, you should get this 85,000. So try it and let's see. You meet similar thing when we are doing capital reduction. Okay, so are you getting the recoverable amount in total? Hello?
Yes, 85,000.
Yes. So this one was the first one, this one was second, and this one will be the pro rata basis. Okay. So please, is it difficult? This one is it difficult? So let me kind of correct. Please, is it difficult?
This one there is not.
Okay.
This is even
OJ.
better than the other one. Yes,
OJ.
yeah.
Is it okay?
I can hear you. Yes,
Is it
yes,
okay?
yes. This,
Okay. Stella.
yes, I'm okay.
Okay. Stella.
Yeah, please, I'm okay.
Okay, then read illustration 8 for us.
Okay, illustration 8. Junior Mill Limited has identified an impairment loss of 41 million cedis for one of its cash generating units. The carrying amount of the unit's net assets was 150 million cedis, whereas the unit's recoverable amount was only 109 million cedis. The draft values of the net assets of the units are as follows: goodwill, property, machinery, vehicles, patent, net monetary assets, giving us a total of 150 million. The net selling price of the unit's assets was insignificant except for the property, which had a market value of 35 million. The net monetary assets will be realized in full. Required. How is the impairment loss allocated to the assets within the cash generating unit?
Okay. So this one fast. Goodwill. We have property. You also have machinery. We have vehicles. We have patents. We have net monetary assets. Okay, so their current amount before impairment in millions. Okay, in millions. So what should I even do? Okay, so let me bring this time around. Let me bring it million, then million. Okay. So goodwill 13 million. Property 20. Machinery 49. Vehicles 35. Patent 14. Net monetary assets 19. The total has been given as 150. This one, we have the recoverable amount there as what? 109 million. So this one you can determine the impairment and commodity can catch the impairment loss of what? 41 million. Okay. So we are told that the net monetary asset, that one will be the current asset. So we need the okay. So that one will be out. Now, first of all, the first step, we don't have any asset that is useless, valueless, worthless, damaged, beyond repairs. So that one, You come to step 2 on to any unimpaired goodwill. So the moment you see goodwill, the whole amount should be written off as impairment. So here 13. So the recoverable amount will be 0. Okay. Now let's read this. The net selling price of the unit assets was insignificant except for the property, which had a market value of 35 million. Which had a market value of 35 million. The net monetary assets will be realized in full. So that's why we didn't bring any impairment. It will be realized in full. Now, the net selling price of the units was what? Was insignificant except the property, which had a market value of 35 million. So please, who can say something about this particular statement? In
my view, I think the property will not be affected.
Good. Please, are you okay?
Yes.
Because it said that if the market has a market value, the asset has market value, it does not bring revaluation, or it does not result in what? Impairment. Sorry, not revaluation, impairment. Okay. So you are seeing all the assets, the net selling price of the unit assets, so all of them, was insignificant except for property, which had a market value of 35. So I move, we got 35, and one of the indicator, okay, for us to calculate impairment external is when there's a reduction in the assets market value. But here it's increasing because it's 20. Now you are saying that it will be 35, okay, meaning that one will not be affected. So property will not get any impairment. So that one will be 20 here. Please, are we good to go? So we are left with what? Machinery and what? Vehicles and patents. Patent is an intangible asset, but they didn't say anything about it. Okay. Maybe if they said that that intangible asset has no market value, then you see that it will be out. So the total impairment. So let's look at the impairment to be allocated. Now, impairment to be allocated is 41 million. We've taken 13 out of it, the unimpaired goodwill. So how much are you going to allocate?
28.
28 million. Okay. So let's do the proration. So we have machinery. We have patents, vehicles. We have patents. Okay. Now it's 49, 35, 14. So the total will be what?
98.
98. Thank you. And then payment to be allocated will be 28. All right. So let's do the proration. So this one will be the 49 over their total 98 times the amount to be allocated 28. This one will be 35 over 98 times the amount to be allocated 28. This one will be 14 over their total 98 times the amount to be allocated. So what do we have here? For machinery.
14.
Okay. Vehicles.
10.
We have 24. So
4.
definitely this one should give you 4. Thank you. So machinery would take 14. So what will be their recoverable amount? Vehicle will be 10. So the recoverable amount will be 25. Okay. Then the last one will be 4. So which one is taking the 4? Patent.
Yeah.
Okay. 10. Hey, ask my number. So this one was the 25. Okay, so machinery, 49 minus 14.
35.
So let's add it. If you are going to get a recoverable amount 109, let's add everything. If you don't add it, you are wrong somewhere.
Nine zero 109.
Thank you. $109. All right. Anything So let's do the last one. Then we go toward corporate asset and also goodwill. Okay. So illustration 9. Stella. And Abre.
Please, I'm here. Illustration 9. A cash generating unit comprises the following assets: building, plant and equipment, goodwill, current assets, all totaling 1,010. One of the machines carried at 40,000 is damaged and will have to be scrapped. The recoverable amount of the cash generating unit is estimated at 750,000. What will be the carrying amount of the building when the impairment loss have been recovered?
Okay. Thank you. All right. So let's list the assets as we have here. We have building,
700.
equipment,
200.
goodwill,
90.
current assets.
20.
Let's find their total.
1,010.
Okay, it's there already. 1010. We are saying that their recoverable amount is 750. So please, what will be their carrying amount? What will be the impairment for the unit?
260.
260. Thank you.
260.
Okay. Let's look at the steps. Step 1, to any asset that is damaged, whatever. So please, we have an asset, and that one is machine. That falls in what? Plant. That falls within plant and equipment. So we are saying the out of 200,000, 40 of the plant and equipment is damaged and will have to be scrapped. So before we allocate Ankasano, plant and equipment will take 40 of the total 260. Are you with me? Hello.
Yes.
Yes.
I opened bracket.
Yeah, we are with
bracket.
you.
I opened this bracket because there are assets. Okay, that is part of the 200,000 here. 40,000 is damaged beyond repairs, so we have to scrap it, and that's the first step before you come to any unimpaired goodwill. So the whole of goodwill will go. I didn't close the bracket because we are still come to allocate the total impairment to building, plant and equipment, and also current asset is not part. So this one to 20 to realize in full. All right. So one will say, oh, that's a PNE, plant and equipment, when you're data. No, this one is not for the whole plant and equipment. It's just one machine, okay, carried at 40,000. That is damaged. So that's why we are taking the 40,000 out, plus the one we are coming toward, allocate to the whole plant and equipment there. Okay, so now the assets left are just two: building and plant and equipment. But the building and also plant and equipment, so what is the amount to be amortized? Sorry, to be allocated. The total is what? 260,000 minus the 90 goodwill minus the 40 that is damaged. Yeah, so what amount are you going to amortize?
130.
130,000. Okay, so we have plant and equipment here. Now building is what? 700,000. Plant and equipment, don't go and write the 200. No. Already you've taken 40 out of it, okay? It's damaged beyond repair, so we just bring 60. That is the 200 minus the 40. Okay, that's why having 60 here. So the total will be 860. Then we do our normal things. So this one will be 700 over 860 times the 130 million. That's the amount to be what? Allocated. Okay. This one will be 160,000 over 860,000 times 130. So please give me the values here.
106.
106.
And 24.
24. So building would take 106. Then plant and equipment would take extra 24. This 40 was the one that was damaged, plus the one we allocated to it. Okay, so 106, 700 minus 106. What would be the recoverable amount for a building, or the current amount after impairment?
594.
594. Okay. What about this one? So this one, these two will give you 64. 64, 200 minus 64 give you what?
So it would be 136.
136. Please, is this one too difficult? So this is another aspect of it. This is just the trick. So if you understand the P and E, that is all. Everything is the same for the 3 examples we've done so far. Yes, CGU, 3 examples, 3 solid examples. You are okay. Now we have last subtopic under this impairment. Okay. We are saying that allocating assets, okay, to cash generating units. That one can be corporate assets and all that. All right, let's see. The current amount of a cash generation unit includes the current amount of assets that can be attributed to the cash generating unit and will generate the future cash flows. But what they are trying to say is that the CGU that we have here, the unit in account 179, the unit consists of what? Various assets that can be contributed or that can be attributed to the CGU and will generate future cash inflows. used in determining the what? VIU of the CGU. That's the value in use of the cash generating unit. However, there are two problems. One, corporate assets. Now, there are some assets that are used by several cash generating units. So maybe you have one asset via all the assets you are having in the unit are also using them. Okay. And that particular asset, that one, they themselves, they do not generate any cash flow. So they do not qualify as a cash generation unit. So they give an example as what? A head office building or a research center. Everyone can go there to do what maybe he or she likes, or maybe what will bring cash to the organization. So we have research center and all that. But the research center itself do not generate any cash inflows. But is the other asset within the entity which uses that. So mostly the example that we have is what? HQ, headquarters or head office. Okay. Because sometimes they are producing, they are doing the administrative works and all that. They themselves, they do not produce any inflows. Okay, they do not generate any cash inflows. They are just doing the administrative styles and all that. So how do we allocate impairment to these assets? We also have goodwill. Goodwill too does not generate cash inflows independently of other assets. No. Goodwill often relates to a whole business. So as I said, this goodwill thing, you realize when we start IS 38, you understand it well. Okay. Therefore, if no reasonable allocation of corporate assets or goodwill is possible. So if there is no reasonable way for you to allocate corporate assets or goodwill, then a group of cash generating units must be tested for impairment together in a two-stage process. So first of all, what you have to do is that you review the individual units for impairment. So you pick the individual units in the individual assets. Okay. You review the individual unit for impairment. So the individual assets within the unit for impairment. So if you have, example, this unit, you check, the question will give you information for you to check whether there is impairment or not. Then you find the carrying amount, okay, after impairment. So you use their recoverable amount, that's the impairment. The carrying amount of the business as a whole. So you compare the carrying amount of the business as a whole, include the goodwill with what? Its recoverable amount. So what we are just trying to say is that you compare the carrying amount of the various assets with their what? The first step, you review the individual unit for impairment. So you check whether there has been what? Impairment, or there is any asset which is impaired. If you have any asset like that, you deduct the impairment you will see or you determine from the value you see there as their carrying amount. The net carrying amount, you compare that one to the recoverable amount or the business as a whole, their carrying amount. So this plenty talking we are doing, plenty thing we are making noise here, you will not understand. So this one is not only goodwill, okay? You can also add corporate assets. Good. So let's look at an example of that thing. You see here, there was you are saying that Ginyam PLC acquires a business comprising 3 cash generating units. So we have this unit or assets within the unit. So we have A, B, and C. And a head office. So these are different, but this is just the head office. Okay, HO. The carrying amount and the recoverable amount are as follows. So as I said, the question will always give you an information to check for impairment. That is the first step. So with this one, you check impairment yourself. Okay, so illustration 10. That is allocating assets to CGU. That is mostly corporate assets or maybe goodwill. Okay. Now, the reason why we are saying allocating assets to cash generation unit. So this corporate assets, okay, we are saying that the CGU produce single independent cash flows. But this is the case, the corporate assets, sometimes the head office or maybe research center, do not produce cash inflows themselves. That's why we allocate those assets to the CGU. So that's what we are going to do here. So here, Ginyami PLC acquires a business comprising 3 generating units. So Ginyami acquired a business, let's say company A, and that company was having 3 generating units, A, B, and C, and also head office. The current amount and the recoverable amount are as follows. So first step, you should review the individual unit for impairment. So individual unit you have here, okay, you check for impairment. Obviously, head office is not part. So you check for the impairment for A, B, and C. You check for impairment for A, B, and C. So this is what we will do. So you have our A here. Sorry, let me give the format first. So here will be the unit or the asset. So let me just write the unit and asset or asset. The carrying amount. And this time, this carrying amount is not the carrying amount you are seeing here that you are going to pick. No, carrying amount after impairment. Okay, then you do the impairment calculation here. You do the impairment calculation in this column. Then you allocate the impairment, the allocation of impairment loss. And we will get the carrying amount after impairment. All right, so let's see. This one is in millions, but I don't have space, so let me skip it. So the units, we have A, B, C, and what? Head office, HO, head office, or HQ, headquarters. The carrying amount. So first stage here, the carrying amount you are seeing, don't just pick these numbers. No. Just check out for what? Impairment. If there is impairment, deduct it from the carrying amount before you write the net figure. So please, the first one, do you have impairment? Hello?
No.
Good, because the recoverable amount is higher than the carrying amount. So there is no impairment. So we will just record the 120. B, there is no impairment, 180. What about C?
Impairment of 30.
Impairment of 30. So that 30, you subtract it from the 210 before you write the figure. So it will also be 180. And that 180 was as a result of 210 minus 30. So you subtract the impairment of 30 from the current amount before you bring it here. Head office is 75. You will not get anything here. So please, let's add it. What are we having here?
$255.
255.
Come again.
255.
255. From this place up to this place.
655.
From A to HO. It's not just the two. From here. He said what?
655.
655.
555.
Okay. So from A to HO. Now, how do we do the impairment calculation? This one, HO, they do not generate any cash inflows. Okay, it did not generate any cash inflows. But you want to allocate impairment to that thing. It could be goodwill, research center, head office, and other corporate assets. Okay, so this is what we are going to do. You look out for the impairment as a whole. Okay, impairment for the whole unit. So this is what you are going to do. So the recoverable amount will be what? The recoverable amount is what we have here, total 540. 540. So the allocation loss, that's the impairment, 555 impairment is what? The 555 minus the recoverable amount. So the 55 is the carrying amount minus the recoverable amount. So this one will give you 15. So at the end of the day, we should get a total impairment of 15. Okay. So this is what you're going to do. You pick the 120 here over the total 555 times the impairment 15. That's what they will take here. Okay. This one to 180 over 555 times the impairment loss of 15. The same thing here, 180 over 555 times 15. This is what they will get as their impairment. So this one too, then corporate assets will now get a chance to have share of the impairment. So 555 times 15. That's what they will take. So please give me the figures.
3.24.
So 3. Mm-hmm.
Then 4.86.
5. Let's round it to just a whole
Okay,
number.
then the other one too is 5.
Mm.
And we have 2.
2.
Okay, so let's give me the after. So this one will be 117. This one will be 175. You subtract this from the 120. Okay, this from the 180. This one, so this one will be 175. Then this one will be 73. Okay. And this one, mostly copy reporting, but I'm not going to. Okay. So please, we have some past questions here. You can try your hands on it. You can try your hands on it. You see, the area and one never pass question. See, cash flow. This 50,000. No, we will come a residual value. Let's see. The last year, they added 50 to the 170. So this is the last year, 170. So let's see if there was any residual value. Yes, the plant had an estimated residual value of 50. When you were starting, I just mentioned it here. When you are determining the value in use, add the residual value in the last year of future cash flow. Okay, so this 50, you know, and on the count, here is it. And on the count, I say, you know, I'm determining discount factor. We are 10%, so it will be 1 over 1 plus 10%. The first year will be 1, second year will be 2, third year will be 3. We were living at 3 decimal places. They left it at 2 decimal places. It doesn't matter. They got present value or money away. So what we have been doing, you know, difference is be anymore. Just some weddings being on now. If you understand it that way, that's all. See the recoverable amount here, carrying amount, you have impairment here. How do you treat it? So you credit the PP, you reduce the assets by 4.2. So the same thing, it's the same thing. It's the same thing. See. This one, hey, I didn't know it was a past question. CGU, the one we solved. Here. Where is it? Where is it? I think this one, yes. You see. Past question no. Now for no. FR, but they can repeat it in CR. That one doesn't matter. See, 5 solid marks. I've been telling you, corporate reporting FR. If you get 2 marks, boom. Here. Simple near here no 5 marks. This simple thing, if you do it 5 marks. Okay. So it's not anything different from what we've done today. All whatsoever this one to is CR. But when I said the document, kindly read through. Okay. Now you still have some time left. I want to introduce.
But I think we had impairment in our just July exam, so Nana.
Oh, I haven't checked the standards.
Really?
Yeah.
Do you have impairment? Did you have impairment? Okay. Well, what type was it?
Cash generating units, I'm sure.
Cash generating unit.
Yes.
Yes.
Okay, so it's likely out. Okay, impairment is, but for shiggy reasons, we must at least the 22 standard here. We should have
For
general
now,
knowledge.
since they've been able to repeat cash flow, they are capable of
We
it.
can't trust them again.
Mhm.
Okay, so
Yes.
let's start with this thing, the IAS 38. Hello, host.
Okay. You can stop it all.
Okay, okay.